QuickBooks Pro Desktop 2021. Forward contract for speculation that foreign currency will strengthen, adjusting entry. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in problem 2, multiple currencies forward contract practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In a prior presentation, we entered the forward contract. Let's take a look at that at this time by going to the reports dropdown. Company and financial, take a look at that balance sheet standard, the standard balance sheet. We're going to go to the customized reports up top, changing the dates from 01/01/21, 12/31/21, and OK. So this reflected the fact that we put the accounts receivable on the books and a payable on the books for equal and opposite amounts. The receivable represents the money that we will be receiving, not in US dollars, but in foreign currency units. In our case, that being the Australian dollars. We're going to be receiving 100,000 units or Australian dollars in the future. I believe it was 120 days. We put it on the books at the current value, not using the current spot rate, but using the forward rate, thinking about what the rate that basically speculates what the exchange rate will be 120 days from now, because that's the forward contract that's what we do with a forward contract typically. Then we have the payable side, meaning we're going to speculate again what the value will be in US dollars, but this one will not change on the payable side. We're going to keep that constant because we're actually going to be paying in dollars. So the thing that then will fluctuate now is this receivable. This receivable will now fluctuate, and we're going to have to record the fluctuation that might take place. Now, it's still kind of a normal kind of receivable the way we put it into the system, meaning the contract will end in 120 days. We're going to be receiving payment on it, and we can record it in a similar way going to the home page as we have with other forward, contract, other foreign exchange receivables, other foreign receivables we put on the books. We put it on the books with an invoice. We're going to receive payment in the future at some point. And we can use the same kind of technique to have QuickBooks help us out to figure out the gain or loss on the different rates when we have the received payment here. However, we might have in the middle, as we do here, this cutoff date at the end of the year, and therefore need to revalue our item as of the year end point. So now we got this middle point that's happening that we need to basically revalue for the end of the year. If I go back to the balance sheet, that means we got to revalue this one at the end of the year as of 12/31. Now, when we do so, it's still a little bit tricky because we still have to use a forward rate. We're not going to use the current exchange rate because it's a forward contract that we're using here. So let's first think about that in Excel. Then we'll come back here and see how to put it into the system. If we go into Excel, we put this on the books originally. The receivable we put on the books for the 100,000 Australian dollars, not times the spot rate, which would be the current exchange rate if we were to exchange as of the point in time we put it on the books, which is 12/1/X1 or 2021, but rather the forward rate, which is the market rate that is speculating, the market speculative rate to what the exchange rate might be 120 days from now. So we're kind of aiming towards this 3/31/X2, which is 120 days from the first point. So we're kind of aiming towards that item and trying to look at the forward rate until then. So the end date doesn't change then. The end date's going to be that 3/31/X2. What changes is going to be our speculation into the future until we get to that point. So basically, it's at the end of the year now. We're not going to use the spot rate to revalue. We're going to still use the forward rate, but the forward rate has changed because we're closer to the date now. So the speculation has now changed, and we're going to have to mark that change when we record it on our financials now. So let's pull out the trusty calculator, which we will use to calculate here, and we're going to calculate the 100,000 times the new rate, which is going to be this 0.612, which is speculating what will happen as of that date when this all ends, the end of the contract. 3/31/X2 or 120 days from the start of the contract. So we're going to take that times the 0.612. That gives us 61.2. So it's gone up now. The receivable value of the receivable has increased. Now, so that means there's going to be a difference, 61.2 minus what's currently on the books, 60,900 of the $300. So we have a $300 increase. Now, let's just think about, is that good or bad, or why did it go up or down? Is this a good or bad thing for us? Well, note here before we had $1 would be equivalent to 1 Australian dollar would be equivalent to 0.609 US dollars. Now, and that's using the forward rate, the speculative amount in the future that we think is going to be there as of the end. And then 1 Australian dollars now, we're speculating worth 0.612. The market is speculating. And therefore, you can get more US dollars for the 1 foreign dollar, the 1 Australian dollar. Therefore, the Australian dollar has gotten stronger. And for us, that's good because we're going to get paid in Australian dollars. And if the Australian dollars have more purchasing power than they did, or it's stronger in relation to what we measure our books in, dollars, or what we're going to be paying in, the payable in dollars, then that's good. So it has strengthened, so that looks good so far. So we're going to say, all right, that means the receivables got to go up. So I'm going to say receivable goes up by that amount. I'll do the calculation here. This way, I'm going to say this is going to be equal to brackets. I'm going to take the larger number minus the smaller, so it turns out to be a positive number on the debit side. Close the brackets times the 100,000. There is, once again, that $300 increase. Then the credit then is going to be a gain, right? It's going to be a gain down here, so it's going to be a foreign currency gain, we'll put. Foreign currency gain down here on the income statement. So there we have it. Let's go ahead and record this out. We're like, yeah, we knew it. We knew we were speculating the right way here so far, but it's not over yet. So we're going to go into the foreign currency receivable. We're going to double click on that and say plus, and then we're going to go back on over and say that this is going to be 300. And so that brings us up to the 61.2. And then down here, we've got the foreign currency transaction gain. This is going to be equal to the credit, and that's going to be income. The income statement's going up by 300. That's 61.2 then. 61,200 should be our calculation of the 100,000 times the 0.612. So there we have, and that's the 61.2. That's the 61.2 that we had over here. Right. Exactly. So now let's do it in QuickBooks. So if I go back to QuickBooks here, going back to the home page, then we want to say that there's going to be an increase. Now we could do this with the calculator. There's going to be an adjusting entry to do this. The problem is that we're still using a forward rate, not the spot rate. So in other words, if I go then to the lists drop down, we take a look at the currency list here. Now, if this was in real time, and if it was just the spot rate we were using, and we're doing it as of today, and today was the end of the period, you would think we can go to the activities and hit the rise up, and we want to say, give me the latest exchange rates, please. And then it would give us the latest exchange rates. But those are the spot rates, not the forward rates. So if I want to use this little technique for the forward rates, then I have to kind of manually put that into the system. So I got to go, okay, Australian dollar, double click on that item. And I need the forward rate as of 12/31/21, which is going to be the 0.612. And then we'll say OK. And now it should be able to do the calculation for us and do the adjusting entry for us. By going to the activities, we're going to say, would you please make the adjustment, home currency adjustment, please? And then we want it as of 12/31/21. We would like it for the Australian dollar. And there's the rate. And so we're going to say, go ahead and calculate that. It's going to pick up the accounts, whether they be cash accounts, payable accounts, receivable accounts that are tagged as being collectible or payable or in foreign currencies. In our case, that, of course, being the payable account. That's the one we want. That means we're going to be, this is a receivable account. We're going to be receiving 100,000 Australian dollar units, which was originally on the books at the 60,900. Now, given the new rate that we put in there, which is actually the forward rate, not the spot rate, is the 61,200. And that means that there's a $300 adjustment. That's just what we thought it was going to be. And so we were right. And so we're going to say save and close. And there we have it. Now let's go check it out on the balance sheet. If we go to the balance sheet to check it out, then we have the accounts receivable, double clicking on that. We've got the $300 adjustment. So there's the $300 adjustment to bring us to the 61,200. If I just double click on it, it's just a journal entry. So just a journal entry. So that looks good. If I close then this back out, the other side's going to be on the income statement. So if I then go to the reports drop down, company and financial profit and loss standard, change in the dates from 01/01/21 to 12/31/21. Then we have the 300,000. It puts it in here as a negative expense because it's putting both income and losses into an other expense item. So expenses then, if it's a negative, it's actually income. If it's positive, it's going to be an expense. So it's going to flip back and forth whether or not it's a gain or a loss. I don't know why QuickBooks chooses an other expense rather than an other income account. Seems like they're kind of pessimistic in that sense. They're choosing like the one that's going to be like if it's a loss rather than a gain. But in any case, it's really a gain. We speculated correctly. So there we have there. And so that's the adjusting entry at the end of the period. If I go back to the balance sheet then, note that we didn't do anything to the payable because it's just going to stay constant. And so we're just going to pay the payable as of the original amount that we agreed upon. And then the receivable is the one that's going to vary, and that's the one that's going to determine whether we made a good choice in our speculation or not. We will have made a good choice if this trend continues and the Australian dollar gets stronger relative to the US dollar. So I'm not, it's a good start for us, but the day's not over because we haven't got the Australian dollars yet, so we don't really know. But it looks good as of this point a little bit. It was good speculation.